What's up everyone, welcome back to another video with the Millennial Finance. Every month, the US releases their CPI data, which technically is inflation. And every month, it seems like inflation is getting worse and worse. The Fed has to react by increasing interest rates again and again, and resultingly, stocks are getting hit harder. What's going on, and are we going into recession? Let's find out. Cha-ching! Before we start any of this, we need to cover the basic question, which is, what is a recession and when do we get into one? Who decides if we're in a recession? Is it Cardi B? Well, typically, an economy is deemed to be in a recession if they've had 2 consecutive quarters of declining gross domestic product or GDP. GDP is the standard way that countries use to measure the total value of products and services that they produced. So when GDP goes up, it's a sign that the economy is blossoming, but when GDP starts to go down quarter over quarter, then it is a warning sign because it means that the economy is starting to contract. So, like I said, if we've had 2 consecutive quarters of declining GDP, then technically yes, we would be in a recession. However, the National Bureau of Economic Research, or the NBER, recently changed the way that they see it. Now, the decision to declare a recession is kind of discretionary and it's up to them, but according to them, they will only declare a recession if we see a significant decline in the economy over a period of more than a month. For example, in March of 2020, during lockdowns, we didn't really have 2 consecutive quarters of declining GDPs yet, but the NBER already declared it a recession. Fun fact, that recession turned out to be the shortest one recorded in history. So when was the last major recession? Well, the last one occurred back in 2008 during the financial crisis. Most of us in our 20s were pretty young back then, so we weren't really old enough to know what was going on, which makes the next one, which is probably this upcoming one, new territory for all of us. Back then, the US GDP actually declined 4.3% from its highs to its lows, which at first glance doesn't seem so much, but apparently it is the largest decline in GDP since the post-war era. It was deemed the Great Recession and stock markets fell by a massive 49% over 16 months. That was mainly caused by subprime mortgages, where banks were just giving out loans to anyone and everyone if they wanted to buy a house, and they didn't really care about the credit score of that particular individual. So now that we've gone through what is a recession and when was the last time this happened, what's going on now? So technically, the NBER hasn't declared a recession yet. However, many market analysts and top CEOs like Elon Musk and Jamie Dimon are expecting us to go into one. This time, it's caused by way too much liquidity being pumped into the market to survive global lockdowns over the last 2 years. Back then, yes, we needed a boost so that we can survive because literally everything was closed, but there was just so much money flowing around after a while that what happened was the economy basically became too strong. As they gave people more money, as stocks started to moon from 2020 all the way to the end of 2021, suddenly households had more money, and as soon as restrictions were lifted, people were traveling, people were buying so much stuff, businesses were making so much money, and the economy overheated. Funnily enough, even though we want economic growth, it cannot happen too fast because then what happens is what we're facing now, which is inflation. So the overheated economy caused inflation to skyrocket. Again, inflation is normal, but when it's hitting 7-8% every single month, then it's just way too high, and central banks now have to step in, try to combat this with, of course, increasing interest rates. When interest rates are raised, like I mentioned in the previous video, spending decreases across not only individuals but also businesses, and hopefully this will lead to less spending, let the economy cool down a bit, and at the end of the day, what they're aiming for is lowering inflation. However, despite already increasing interest rates a few times over the last few months, last Friday, the US announced that their headline inflation hit 8.6% year over year, which is the highest growth we've seen for 40 years. The next Wednesday, the Fed immediately responded with a 0.75% increase in interest rates, and again, this is the biggest move in interest rates that the US has seen since 1994, which shows just how desperate the Fed is to try and combat inflation. Before that, many people expected a 0.5% raise, which is why we saw massive blood in the market over the last few weeks, because once we saw inflation data, everyone knew that the Fed had to raise interest rates even more. They're hoping that by quickly raising interest rates, this would solve inflation sooner rather than later, but many people still think that the US has to go into a recession to stabilize inflation. So you guys might notice that I am talking about the US specifically a lot. The reason for that is because we all know that the US is an economic powerhouse, and if they go into a recession, it will impact other countries, including Malaysia. Companies are actually starting to lay off employees, and companies like Coinbase are even rescinding job offers before the guys even join the company. Is it time to panic? Well, the first thing to know is that recessions are completely normal and they are unavoidable. Just like how stocks and cryptos have their ups and downs, they do have their bull and bear periods. The economy has the same thing. Even though it's a painful and unpleasant experience that we all don't want to go through, over the span of our lifetimes, this will probably happen to us at least 3 times. And if you think about it, recessions don't even last that long. The Great Recession in 2008 was the longest recession that the US has seen since World War II, and it only lasted 16 months. I know, you guys must be thinking 16 months is kind of a long time. We don't want to see our bags continue dropping, and we don't want to see companies struggle and then, firing people or hiring less people for 16 months. That is a long time. However, when you compare these periods of recessions to the economic booms, then it's not even close. For example, the last economic expansion that we had after the financial crisis up till February 2020, that lasted 129 months or nearly 11 years. Even the smallest cycle of economic expansion that we have on record lasted 12 months, which is nearly the same as the longest recession that we've had since World War II. So for those of you who are panicking because this is the first time you're going through a recession, then you know what? All I have to say is don't worry, because this is my first time as well and I am panicking. Just kidding. In all seriousness, the economy will eventually recover, and it's always darkest before the dawn. On an individual level, the most important thing that I would say every single person must do with regards to personal finance is that they must secure their rainy day funds. Yes, we talk about it a lot, even at the very start of the Millennial Finance in 2020, and the economy was doing sort of okay, but especially at moments like these, the rainy day fund really shines. Yes, people will say that if you just hold cash, it's getting eaten away by inflation, but at the end of the day, when push comes to shove, cash is king. We're not going to pay for food, rent, electricity, and all of that with Bitcoin or with Amazon stocks. People only accept cash. It may be diminishing in terms of its value, but we still need it. I hope this doesn't happen, but on a worst case scenario, let's say, touch wood, we get let go by our companies, at least this rainy day funds can help us go through it. If you want, you can put this cash into very, very safe investments. If you're Malaysian and you're eligible, then something like Amanah Saham. If you're not, then you can go for stuff like KDI, Versa, or Stashaway Simple. KDI currently still gives 3% returns on their safe product. I don't think they've changed it, I haven't checked, and even though that this 3% is lower than inflation, it's still better than nothing. So if you've got this covered, you have a 6-month or 1-year rainy day fund, then what you can do next is of course to continue investing, because in my opinion, these are excellent opportunities for us to compound our wealth. Again, I don't know when things will bottom, but they've been really getting a beating recently, and many quality stocks are down over 50% already, even though the indexes are just down 20 to 30%. I mean, look at the Monday, 13th of June 2022. Nearly every single stock in the S&P 500 was in the red, and this is an extremely rare scenario. The reason this is rare is because usually in any market condition, there will always be winners, and it's the same situation for inflation and a recession. Companies like the oil and gas industry will still do well because the price of oil is high. However, I guess the panic of high inflation rates and the looming increase in interest rates made investors book out and literally sell every single stock that they had. If you look at the recent charts of the S&P 500 and the Nasdaq 100, then it looks like these stocks fell off a cliff so quickly that our 60 FPS eyes couldn't even see it. I mean, there were 2 gap down days in a row, and then shortly after that, there was another gap down day. So this is extremely bad sentiment that we're seeing in the stock market. Like the famous quote that we always hear people saying is that buy when there's blood on the streets, even if the blood is your own. However, I wouldn't recommend you to go all in because, like I said, we never know when the bottom is. So just start dollar cost averaging and, do it every single week, every single month. If you have the extra cash, I would definitely put more money into investments during this time period because millionaires are made in bear markets. One thing to know for those of you who feel like, you want to sell everything and only buy back when the economy is starting to get better, we're out of a recession and whatnot. Well, all I have to say is that that's not really a good idea. And the reason for that is because usually the stock markets will bottom before the economy. So what will happen is we will start seeing, inflation numbers still high, but the stock market, instead of going down, this time it goes up. This will be especially apparent in highest quality stocks who will be ready to make a leg up as soon as we get back in a bull market. The reason that this happens is that investors, they are extremely efficient, they are forward looking, and in my opinion, as soon as they get signs that the economy will start to recover in the next 3 to 6 months, then they will start piling their cash back into stocks. The only reason that they're declining right now is because there's just so much uncertainty. We don't know if the Fed can get inflation under control, and as usual, the number one thing that investors hate is uncertainty. So, in my opinion, it does look like we are heading into a recession. The term recession is just a technical thing anyway, but we're really starting to see economies falter. People are getting let go, job offers are being rescinded, and investments are getting sold off relentlessly. All we have to do at this point is to make it out alive. Don't try to be too clever with your money, especially with your investments and your rainy day funds. Practice risk averseness at its most, but continue investing. If you have the money, continue building your rainy day funds. That's it for today's video, guys. Thanks for watching till the end. Give us a big thumbs up and subscribe to our channel if you haven't already. If you want to sign up for a brokerage exchange to start DCAing, then I recommend Interactive Brokers or Rakuten if you're Malaysian. Check them out. We'll leave the links down in the description below. See you guys in the next one. Peace out.